This is Chapter 10 and Part 1 of a three-part presentation. And the first part is going to be what happens when we purchase PP&E in terms of what costs do we include and how do we record it. Now, property, plant, and equipment. These are tangible assets and they are required to be used in the business and they're not for resale. They're long-term in nature and are expensed through depreciation, excluding land. They possess physical substance. Let's look through some examples and determine how the costs are recorded based on general accepted accounting principles. So what happens if we buy property? Well, we would include the purchase price, the closing costs and the legal fees, the assumption of any liens, property taxes, or encumbrances, but it doesn't include future property taxes. Those are treated as an expense. Title searches and title insurance. Any costs associated with getting it ready for its intended purpose would also include demolition of any existing structures, less any amount received for salvage, any improvements that have an indefinite life. An example would be if you planted a tree. Okay, that's going to last a long time. Clearing and grading costs. So it's all the cost associated with getting it ready for its intended purpose. I think that's the best definition. So now let's walk through an example. We purchased a building and land, and the following additional costs expenditures were incurred. We repaired the building for $105,000. We constructed a base for new equipment. We installed a driveway, remodeled the building, and we had a special assessment by the city. So the first one, repairs on the building. So first what we have to do is categorize these. Where are these going to go? So repairs on the building would be capitalized as part of building. Construction a base for new equipment would be part of the cost of the equipment that would be capitalized. Installment of driveways and parking lots would be part of a separate category called land improvement. Remodeled building would be part of the building, and the special assessment of the land would go to land. So this is what our journal entry would look like. We do building, equipment, land improvements, and the offset we assume we paid cash. Now what happens if we bought a purchase and it was what we call a lump sum purchase, i.e. we pay a fixed amount for 2 or more items and we have to then allocate the costs. And so the way we do that is, here is our example. We have 2 buildings and 4 acres of land for $900,000. The fair value of building A was $450,000. The building 2 was $250,000, and the fair value of the land was $300,000. So what we have to do is we have to allocate the $900,000 between these 3 items. So building A, as you notice, when we add up building A, building B, and land, we get a total fair market value of $1 million, which is greater than $900,000. So what we have to do is prorate the $900,000 based on a weighted amount. So we're going to take the $450,000 for building A and divide by the total fair market value, which gives you a percentage of 45%. And then we take that times what we paid, and that tells you how much of the $900,000 we are going to allocate to building A. Now we do our journal entry. Building A and B would be $630,000, land would be $270,000, and the cash would be $900,000. Now what happens if the buildings were no good, we were going to get rid of it and put a brand new building on it? What would the journal entry look like? All of it would go to the land. Okay? Now our next example is, what happens if we donate an asset? So the rule is donated assets are booked at fair market value and treated as revenue. Okay, the city of Pebble Beach gives the company 5 acres of land as a plant site. The fair value of this land is determined to be $81,000. Our journal entry would be land and contributed revenue. Now let's look at another example. What happens if we have an exchange for some property for stock? And this happens a lot for startup ventures because they don't usually have a lot of cash. So, if the stock is widely traded, use the fair value of the stock. If it is not, use the fair value of what is known. So in our first example, a company issues 1,000 shares of its $1 par stock, but it is not widely traded for a $20,000 piece of equipment. What is the journal entry? Well, equipment would be $20,000 because we know that value. Common stock would be $1 times the shares, and the difference would go to additional paid-in capital. Now for same example, what happens if the stock is widely traded and has a fair market value of $25? Well, then our equipment would be worth $25,000 because if we take 1,000 times 25, we get a total of $25,000, and common stock would still be 1,000, and then the difference would go to additional paid-in capital. The next thing we're going to cover is how do you come up with goodwill? Well, one of the ways you get goodwill, you can't create goodwill, but you can get goodwill if you buy another company stock and you pay more than the fair market value of what you receive. So here is our example. They buy company A, and the book value, this shows you the book value of their assets and their liabilities, and it also shows you the fair market value of their assets and liabilities. So the first thing you need to do is add up their total assets and subtract their total liabilities to get our net book value. So the rule is, what we need to do is we need to figure out how much the goodwill is. So we paid $11 million. The fair market value of the net book assets is $10.5 million. So therefore we have goodwill of $500,000, which we can book. Next, we're going to look at what happens with acquisition costs, and we have a non-interest bearing note. So in this example, we purchased a truck and paid $16,000 down and signed a non-interest bearing note due at the end of 3 years for $70,000. An interest rate of 7% reflects the time value of money for this type of loan. What is the journal entry at the time of the purchase, the interest expense for 2 years, and the liability for each year? So, first we have to determine the present value of $70,000. Now I'm using present value because this is a single sum that's received at the end of 3 years. So I go to the table, I have a single payment at the end of 3 years, and N is 3 and I is 7, and there's my factor, and I take it times the $70,000, and that gives me the net present value of the $70,000 in today's dollars. So now what I'm going to do is I book the cash and the notes payable. The equipment is the $16,000 plus the net present value of the non-interest bearing note, and the difference is going to be discount on notes payable. Now what we're going to do is amortize that discount over time. So at the end of the first year, we're going to have interest expense, which is going to be, since we're using the effective rate, whenever you use the effective rate, you always do interest expense first, and that's always going to be the net value of the note, which is the face of the note minus the discount or plus the premium, times the effective rate, in this case is 7%. Then we're going to take that against discount on note. For the second year, what you want to remember to do is you've already written off $4,000 at that discount, so you have to reduce it, which means now the net book value of the note is going to be higher, and you're going to take it times the 7%, so your interest expense is going to be higher. Now, what is the balance in notes payable at the end of year 3? Well, here's what would have happened. We would have had a net book value at the date of the signing of $57,141. And here's what you're trying to do as you expense that discount. At the end of 3 years, that balance should be $70,000 because that's the amount you're going to have to pay. So the first 2 years we wrote off $4,000 and then $42,800. And for the third year, what we're going to do is we're going to take our $57,141 minus our 2 years that we've already written off times 7% gives us $45,79, and at the end of 3 years the net book value of our note is going to be $70,000. So that's how that works. Now, the last thing we're going to be talking about is non-monetary exchanges. Non-monetary exchange, it can include some cash, but it also cannot. So it could go both ways, but ordinarily accounted for on the basis of the fair value of the asset given up or the fair value of the asset received, whichever is clearly evident. Remember, the easiest thing to figure out is the gain or loss because it's always the difference between the fair value and the book value of the asset given up. Now, another thing they talk a lot about is commercial substance. Commercial substance. Does the exchange affect future cash flows? Which means by doing this exchange, are you going to increase either production or the amount of cash you're going to produce by doing this? An example would be you give an old computer for a new computer. If it has commercial substance, you recognize the gain or loss. And I would say in 95% of the case, it does. Now, if it lacks commercial substance, and the only example of that would be is you have an old truck and you exchange it for another old truck. In the case of lacking commercial substance, you recognize the loss, but you have to defer the gain. And I'll show you examples of all of these. So here is our example. Danny exchanged a building that had a fair value of $1.4 million and a net book value of $800,000. For a building owned by Mike with a book value of $950. Plus, they received $140,000 from Mike. Now, what we're going to do is do these transactions on both people's books. Now, on Danny's books, he got $140,000 in cash. He had to take the accumulated depreciation off the books. He had to take the old building off the books. So you always want to remember to do that. The next thing is the gain. And how do we get the gain? The gain is always the difference between the fair market value and the book value of the old equipment, which is $600,000. And then the last is the plug. So just remember that. If you do it like that, you always get it right. Now, same problem. What is this going to look like on Mike's books? Well, we're going to take the accumulated depreciation off the books, the building off the books. We're going to book the cash. And we have a gain on exchange, which is the difference between the fair value of what was given up and the book value. And the new building is going to be 1.4. Now, our last thing we're going to look at is what happens in the same example if it lacked commercial substance. Well, here's how that's going to be done. We're going to take the accumulated depreciation off the books, take the building, book the cash, and the building is now going to be reduced by the gain, the new building. So that's how you would do that. Now, this concludes part 1 of our 3-part series for Chapter 10.